Oh boy, this is something you don't see every day. Stifle's Nicholas & Co.'s Barry Bannister says this rally looks like a 1990s dot-com bubble all over again. He expects the S&P 500 index to plunge to the very low 5,000s by the fourth quarter, a roughly 13% decline from the benchmark's closing price of 5,700 on Thursday. His bearish warning is a notable contrarian call at a time when most market forecasters have been raising their S&P 500 forecast through much of this year to keep up with a 20% rally in the index. In the past week, Deutsche Bank and BMO Capital Markets were the latest to do so, with BMO betting the gauge could surpass 6,000 by year end. Bannister, on the other hand, sees a multitude of risks. He said while a 3-year generation high on the price to earnings ratio of the S&P 500 and the outperformance of growth versus value stocks may look rosy, peaks in those trends have always preceded bear markets for the last 90 years. Waning labor demand that is a symbolic of recession risk is also a headwind, among other considerations. In his warning, Bannister said it's not all about the Fed direction. Strong markets in the past happened when the US was, quote, essentially unchallenged, something that is not the case today given geopolitical risks posed by China, Russia, Iran, and North Korea. Before his most recent call, Bannister had said in June that the S&P 500 has a shot of reaching 6,000 because of bubble-like mania, only to see it plunge as low as 4,750 by the end of the year. The index was trading just under 5,700 on Friday. Now, what's actually interesting is the forecaster here, Bannister, was one of the few strategists to correctly predict the stock rally in the first half of 2023, while most of his peers delivered recession warnings. But then Bannister took a bearish turn, first predicting flatness in the S&P 500 and now a big drop, views that have so far failed to materialize. Ahead of the summer, he was right in calling a correction, with the US stock gauge falling as much as 8.5% from peak to trough during August's bout of volatility. You know, Bannister here, he's not wrong. Take a look at this, okay? This is consensus estimates for S&P 500 EPS growth by year-end 2025. We are expecting, as a collective market, 18% year-over-year growth. That is insane. 18% year-over-year EPS growth? What? That is like literally .com level shit. This would be the fastest EPS growth rate on the S&P 500 since 2018. And before that, you have to go back to 2010 to get a faster EPS growth rate. And this was coming out of the global financial crisis, or great financial crisis, whichever terminology you like to use to define the '08 recession. So in other words, these are very lofty expectations, especially as the consumer has clearly slowed down. The Fed has basically capitulated and said, we have a problem. We just cut rates 50 basis points. And if you read the last beige book, the part where it says here, economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior month to 9 in the current month. That's almost a 50% rise month over month in districts that are reporting declining economic activity. 50% boost from July to August, with economic activity that grew, quote, slightly, like not much, in only 3 districts. So only 3 districts actually are growing economic activity out of 12. That means only 25% of America is actually growing right now. I mean, I don't know about you guys, but I don't think that's a very supportive market backdrop to give us the best EPS growth rate we have seen since 2018, but before that, since 2010. Like, this would be the 3rd best year for EPS growth since the great financial crisis at the current expectations that we are still at. And this is why here on this channel, I have been warning frivolously, if that's the right word, about what is coming next. Because the bottom line is, whether or not we head into a recession really doesn't matter in the grand scope of things, just like we've seen in 2022. It's all about expectations. So let's say over the next coming months or after the election, perhaps November and December, economic data starts to look really bad and more accurately reflect what's going on in the consumer, in the economy today, along the lines of the Fed beige book, right? If we start to get that bad data, Wall Street's going to jump to that recession call quickly, and we're going to be forced to price that in. Now, I've said this here on the channel a lot, and it sparked a lot of interest with you guys down below in the comment section, but I've talked about the markets not pricing in this recession risk. And that's the actual risk in investing in markets today. It's kind of like Nvidia's earnings, where everyone's expecting just things are going to be awesome. And then like we seen last earnings season for Nvidia, things were awesome, but they were not as awesome as we expected. Instead of a $2 billion guidance raise, we got like a 600 million guidance raise, which is still really good, but it's not the 2 to 4 billion that we had previously experienced in prior quarters. So it was a disappointment. That's kind of like the S&P pricing in 18% EPS growth, and then we get something like 10% EPS growth in actuality for 2025. 10% still really good, but it wasn't the 18% we were expecting. And specifically, I've talked about here on this channel, markets are not pricing in a recession at all. In fact, the odds of a recession are 0%. And I've had a lot of people in the comment section say, how do you know the markets are not pricing in a recession? Well, 18% EPS growth rates for the S&P after coming off of very strong multiple years is not pricing in a recession, right? That's the farthest thing from a recessionary environment. And you have the multiple on the S&P trading around 20.5 to almost 21 times those 2025 expectations. And the problem will ultimately arise because we are expecting around $280 of EPS, times this by a 20.5 times multiple, and you have an S&P that's at 5,740, which on the SPY would be 574. Today, you're at 568. So you are pretty well already priced for perfection. You need to see an upside surprise above that 18% EPS growth rate target, which becomes just really unlikely at that point. And then perhaps, what if EPS only does come in at around 10% growth? Then that's problematic. Say S&P 500 EPS growth only comes in around 252 or so. Times that by the current multiple, and you're looking at an S&P with a fair value of 516 for the SPY. Now, that's not all that terrible, considering we're at 568. Yes, that is downside, but that's not the end of the world. If recession starts to get priced into markets, though, many, market commentators, analysts, and banks may say, hey, we could actually see declining EPS growth next year or declining EPS growth in 2026, and that could take markets far lower than 516. And that is the risk in the longer term in our markets, or medium term. Longer term, medium term, short term, it's all subject to your various opinions. In my opinion, short term is like the next 1 to 3 months. Medium term is like, 3 months to 2 years. Long term's like 5+ years, okay? But in the medium term, after this election, that's when I think you really want to be cautious. That's when I think we're vulnerable for that larger downside. And unfortunately, government data that we get is not very accurate at all. Let's just face that fact. The Fed is not being honest. They're just not. I've explained how we know this here on this channel many times. But you know who is legally obligated to be honest? It's corporate America, because they will go to prison if they are not. It's the only area of the economy that you have a legal ramification if you lie. So I think this earnings season is vitally important to see what companies are saying, what they're projecting. Projections and forward guidance, you don't necessarily have to be honest with that. Now, yes, there is a gray area. You want to the best of your ability, be honest, but you're not penalized for giving guidance and then missing on that guidance. But certainly, if this earnings season is anything like FedEx's earnings that just came out this last week and the warnings that they gave, which we covered here on this channel, we have a problem. That's more after the election, heading into 2025. The months that I am really concerned about would be November, December, January, February, and March. If we can get through March of 2025, really the first quarter earnings season of 2025, and we're okay, then I think generally we're probably going to be okay. We're probably not going to be heading into a recession at that point. That's the moment in which I would start to really recalibrate, some of my calls here on this channel. Fortunately, I think there is a very low likelihood that things get just really good from here. Like there's no downside risk to the economy, that things are better than expected. Like that just doesn't seem very likely. And trust me right now, I'm looking for anything that I can find that supports that conclusion, that supports everything is just fine. And the more I try to find that, the more I find things that sound alarming. Now, as I have said here on this channel as well, I do think the markets are in a period in time that is filled with a sugar high, if you will, for lack of a better word. We just got a 50 basis point cut. That instinctively does raise the odds of a soft landing. Okay, Wall Street is fixated on soft landing. They have been since the second half of 2023. It's been 18 months now that Wall Street has priced in this soft landing. And now after the first 50 basis point cut, I don't think the markets are going to easily change that view. But when that view starts to change, it's going to happen rapidly, like all at once. So I think there are areas of opportunity, whether we go into a downturn in markets, into a full-blown recession. I think there's areas that are accurately priced for that. And that's what's weird about our markets. It's not a broad-based, just very strong market rally. No, you have cyclicals and small caps and value and dividends. Some of these stocks are trading as if we are going into recession. Look at Whirlpool. Look at Dollar General. Right? Look at some of your other retailers that are dependent on the consumer. They're priced for something totally different than what the broader S&P is priced for. And I think those areas have the real opportunity. If we do avoid a recession, those areas need to be repriced again, right? And if we do go into a recession, they're more accurately priced for that pain. I even think something like Tesla in the near term could do very well with their upcoming robotaxi event, with rates falling. That's obvious. That should be good for autos, even though the Fed cut rates and treasury yields actually went higher. I do think there is opportunity in the short term. I know a lot of people have talked about silver and gold and Bitcoin, and those things have obviously been working well. So you don't necessarily have to sit out this market, but I do think putting fresh capital to work here doesn't make a whole lot of sense. And this is always a balance of risk to reward. Like, what is the potential reward in the headline S&P investing at these levels with the expectations that we have? Not that much upside. Even if we meet those expectations, we're already priced for them. We have to exceed those expectations. How likely is it that we exceed 18% year-over-year EPS growth after what was 2023 and 2024 that were strong years for corporate America? Like, the odds are falling of that, especially as the consumer is starting to slow down. So I don't think there's much upside in the S&P. And if Wall Street is wrong in the pricing of what EPS is going to look like for 2025 or the recession risk out there, then there can be sizable downside. And that's the concern at this point. The concern is not missing the upside. The concern is looking past the downside and missing that when it comes. So I personally think the best thing to do right now is hoard cash like it's going out of style, because I do think over the next 3 to 6 months, you're going to have a fabulous buying opportunity. And that's where you can make a lot of money in a short amount of time. Like, this is the moment in which the Fed is really going to start slashing rates, whether you're looking at real estate or stocks. I think things are going to look better 3 to 6 months from now as far as a purchasing standpoint. I mean, there's no wonder why Warren Buffett is like 35% in cash right now, holding over $200 billion. Like, he sold a dramatic amount of his portfolio in the last quarter. There's a reason for that. I think he would generally agree with what I'm saying here in this video. Now, as Warren Buffett also says, most people, average people that are not watching these videos, because if you are watching these videos, you are indeed not average in the financial sense, cannot time the market, so don't try to. But I think if you're watching these videos and you stay up to date with markets, there's a good time and a bad time to invest. It's pretty easy in the short term to time the markets and to time your buys if that is something you actively do and you are actively participating in this market. I mean, I called out this correction that we had in both of them, actually, in the spring and in the summer. Like, literally 4 days before this correction started on July 9th, I said, guys, we are about to go into a correction. That wasn't a very popular call at the time, but just 5 days later, that correction started. I think this is another one of those instances where I will be right, but it's going to take some time. And I acknowledge I'm early. So keep that in mind. Which, again, I'm just fine being early, because I think the sooner you understand saving as much money as possible right now is going to put you in the best situation possible, well, that's a good thing. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.